Welcome to another edition of Taking Stock for the week ending the 20th of June 2025. I'm Trinh, Head of Research at Stock Doctor, and joining me today is our Senior Equities Analyst, Jason Yin, to stream to your thing share market. Welcome aboard, Jace.
Thanks for having me, Kien. It was a pretty interesting week. You were up over in Sydney, and I was down here in Melbourne, and had a lot of interesting conversations with a lot of our members.
Yeah, definitely. It was great to catch up face to face with our members and really talk to them and explain to them about all the benefits around this Prime and Lincoln Indicators partnership. But before we begin, just remember that everything we discuss today is general in nature and doesn't constitute personal advice. As always, share markets are volatile, and past performance figures is not a reliable indicator of future outcomes. But Jace, it's been quite an eventful week in global markets as well. In the US, you had the Federal Reserve keeping their interest rates on hold as expected, but also flagged that heightened uncertainty around the global trade and also rising geopolitical tensions. Of particular concern is the escalating conflict in the Middle East, with Israel and Iran bombing each other and the US now becoming more directly involved. This is, of course, sending oil prices sharply higher.
Yeah, it is rather concerning with what's happening over there. But closer to home, Kien, confession season continues to create a little bit of stock-specific volatility, Kien. For example, outdoor retailer Kathmandu or KMD Brands issued another unfortunate profit warning, and management citing a weaker sales due to the unusually warm autumn period. And this highlights the growing trend of earnings downgrades that we've seen from the company over the past couple of years, and specifically within the retail sector, which has been driven by tighter consumer spending and also shifts in terms of demand patterns.
Yeah, that's right, Jason. And with the market still quite elevated and the reporting season fast approaching, this is a good time to ensure you have strong portfolio risk management protections in place. Investors should ensure that they're not overexposed to vulnerable sectors or stocks. Look at the financial health under Golden Rule 1 or negative earnings revisions under Golden Rule 3, and make sure you're monitoring this closely.
Yeah, very sound pieces of advice, Ken. And also, the free lunch, obviously, in the markets is to remain diversified. And that means to take profits on stocks that have obviously taken a large chunk or contributing to a large chunk of your portfolio, and potentially selling out of those financially weak businesses to offset some of the gains at the end of the financial year. Remember also to build up a little bit of cash to take advantage of any opportunity that may arise over the upcoming reporting season.
Yeah, and you can easily do this through our portfolio manager and our portfolio optimizer as well. Within Stock Doctor, you can also generate detailed reports for your investments over the last year and hand it over to your accountant. But let's turn now onto some of our star stock highlights for the week. First up, let's talk about ex-star stock Accent Group, best known for their popular retail banners like Platypus, Hype DC, and the Athlete's Foot.
Yeah, we've had a pretty long period of coverage for Accent One. Unfortunately, the company downgraded its FY25 earnings guidance by nearly 19%, and management was citing like-for-like sales decline in the second half of around 2.5%, and also contraction in the gross margins due to heightened discounting and obviously inventory clearance as well. This sort of reflects the broader retail challenges that I mentioned a little bit earlier, and what we've seen across the market, which is subdued discretionary demand and also persistent promotional pressures in order to clear out some of the inventory before the next season comes through.
Yeah, and as a result of that, we've had to remove the stock from coverage. And due to those heightened risks in the short term, looking at the return on equity, that's expected to decline by around 12 to 13%. And net profit margins, are likely to fall below our 5% threshold as well. So it will unlikely meet our star growth stock criteria when it reports in August.
That's right, Ken. And also on top of that, the full year dividend was cut by around 20%. And with some of the rising risk from soft consumer spending and also limited management visibility and potentially growing structural challenges as global brands like Nike shift to a more direct to consumer model, we felt that it was a little bit prudent to step on the sidelines and reassess some of the, if there are evidence or if there is evidence of a margin stabilization. And this could potentially help firm up our investment case perhaps even in first half FY26.
Yeah, so we're watching this one closely. With that said, though, this is still a founder-led business with strategic leadership under CEO Daniel Agostinelli. The long-term opportunity in active lifestyle and value-focused retail remains intact, but we see better opportunities elsewhere, particularly within the retail sector.
That's right, Ken. And it's also a timely reminder for investors that not every single investment will work out as planned. In the equity space, there's always a degree of uncertainty, especially in cyclical sectors like retail. So expect a win rate of around 55% or so. But the key is to stay disciplined, of course. Stick with high quality businesses that align with your objectives. And over time, your winners should offset some of the inevitable losers that we all experience from time to time.
Moving from retail shops to retail centres, HomeCo Daily Needs REIT, the code's HDN, they've delivered a solid asset revaluation update with its property portfolio rising by 3% over the last 6 months. And that's thanks to higher rental income and supportive capital rate trends. Now, the trust declared a quarterly distribution of around 2.125 cents per unit and reaffirmed their financial year 25 guidance for 8.5 cents of distributions on the back of 8.8 cents of earnings as well. And that's a 2.4% lift on last year and implies an unfranked yield quite attractive at around 6.5%. And remember, the stock goes ex-dividend around the 27th of June this month.
Yeah, it's pretty good to see some positive valuations over in the REIT space.
Mm.
Finally, a quick note on CSL. The biotech giant has received FDA approval for its new treatment, and I'm going to get this wrong, so please bear with me. Hereditary angioedema, which is a rare genetic condition that causes severe swelling episodes in patients. While the approval marks an important milestone for CSL, most analysts have already factored this into their forecast, so many have left their earnings estimates unchanged.
Yeah, good point there. But the growth is still very strong. It's still a high quality business. But the share price has been under pressure lately. And there's been recent reports this week that a US immunization advisory panel are revisiting vaccine safety discussions as well.
Yeah, it'll be pretty interesting to what type of discussions they eventually settle on. But looking ahead in terms of the corporate calendar, Kien, several REITs are scheduled to go ex-dividend on the 27th of June. So that's going to be an important day for many income investors to keep in mind.
This week on Under the Microscope, we're taking a closer look at Santos, a star growth stock in the energy sector, after news broke out of a third and final non-binding takeover proposal from a Middle East-backed consortium.
Yeah, that's right, Ken. The latest offer comes from a consortium led by a subsidiary of Abu Dhabi's ADNOC. And this is in partnership with the Abu Dhabi Development Holding and also the Carlyle Group as well. And this consortium is offering $5.76 US cents, or in Australian dollar terms, just under $8.90 in cash, which represented a 28% premium to Santos's previous share price. And if successful, this could be one of the largest all-cash takeovers in terms of the ASX history.
Yeah, what a takeover, Jace. But the board has agreed to provide due diligence access and it intends to unanimously recommend the deal to shareholders. But that's subject to agreement on some binding scheme implementation and also confirmation from an independent expert as well. So what's next in the process?
Well, the next couple of months is going to be rather critical. Due diligence will be completed by estimated mid-August, and this will be followed by negotiation and obviously execution of any binding agreements and also submission for the Foreign Investment Review Board approval. Now, beyond Australia, the proposal is also required sign-offs from the US regulators, also the regulators from Papua New Guinea and also in South Australia as well. The scheme meeting is expected in the first quarter of 2026, so there are plenty of time left before anything gets approved.
Yeah, quite a complex process there, Jace. But to smooth the path, though, the consortium has pledged to keep Santos's brand. Also, its Adelaide headquarters will remain in place and its operational footprint intact, while investing further into gas, LNG, and also decarbonisation initiatives as well. Still, given Santos's strategic position in domestic gas, particularly in Western Australia, the Foreign Review Board will likely be closely scrutinising this deal.
Yeah, that regulatory approval is definitely the thing that's overhanging the current share price right now,
Mm.
with Santos price trading below the offer price, and this reflects some of the regulatory uncertainty around the time frame and also potential approval or non-approval. From a shareholder perspective, it becomes a question of patience, Kian. Now we know there's going to be a bit of a valuation cap in the short term, and if there are no competing bids coming onto the table, the deal will go as planned, and that could result in a pretty strong outcome for shareholders.
Yeah, but there's also the chance that it doesn't, Jace, especially given where it's trading at the moment. The market certainly is discounting that fact.
Yeah, that's right. And if it doesn't go ahead, Kien, well, Santos will probably revert back to trading on fundamentals. Analyst coverage remains strong at around 12 analysts contributing to consensus. And also the return on invested capital and share price will obviously remain sensitive to any changes in the oil and gas prices as well, which in light of ongoing tensions in the Middle East could see more volatility ahead. It's going to be a classic case of corporate event laid on top of commodity exposure.
Yeah, definitely. Either way, it's a stock worth watching for our investors. Now, for question of the week, following the events surrounding Accent Group, a useful question for our members is how do you know whether a fallen stock is a value trap or an opportunity?
Yeah, this is a very good question, Kian. Well, firstly, let's define what a value trap is, and that refers to a stock that looks cheap, but it may be cheap for a very good reason and could potentially get a lot cheaper if there are any further earnings downgrades are announced or comes up. A value trap tends to have poor financial health and also elevated active risks that could potentially derail the future earnings potential and also the dividend outlook of the company.
Yeah, definitely those earnings downgrades, you've got to watch out for that. And you can assess the earnings trend of the stock by referring to our earnings revisions factor under Golden Rule 3, or also by looking at the earnings trend under Golden Rule 4 as well.
Yeah, and if it's also a covered company, you can refer to the strategic comment and also the active risk section to fully understand some of the risks the company may be facing. You can also have a look at the level of short interest to understand whether fund manager sentiment on the stock is negative or positive.
And don't forget to check Golden Rule 7 and the corporate details page to see whether the directors have been selling their shares over the year, which can raise red flags.
Yeah, insider selling could be a point of concern, Kian. But
Mm.
apart from these key metrics within Stock Doctor, you should also try to understand whether the earnings lull is short term or whether there are longer term structural issues. For example, is the trend towards renewable energy going to have a detrimental impact on fossil fuel companies moving ahead?
Yeah, those structural risks can be quite elevated, so watch out for that. But on the other hand, market volatility driven by systematic or macroeconomic factors often creates opportunities. For instance, the ongoing geopolitical tensions in this Middle East, they've pushed oil prices higher, and that raises concerns about inflation. This in turn can trigger broad-based selling even among our high-quality stocks with solid earnings. So creating that potential opportunity for investors.
But sometimes, Kian, opportunity is difficult to find, especially when there are no consensus forecasts. In this case, you'll probably need to conduct your own due diligence, which is to try to understand the business's competitive advantage and also look at the track record in terms of its financial health, return on equity, and also net profit margins as well. And also, if you have any doubts regarding any of these metrics, feel free to reach out to our team and speak to us. And sometimes it takes a little bit of a deeper conversation to clarify any nuances within the company that you may want to understand further.
Definitely, Jason. And that's all we have time for today. And if you have any questions or would like more insights into what we spoke about, join us for our Lincoln Live episode this coming Monday.
That's right, Ken. And if you know someone that could benefit from Stock Doctor, now's a great time for them to reach out, given our end of year financial campaign is currently live and available.
As always, we are incredibly grateful for the ongoing support from our members. In the meantime, take care and have a happy, healthy, and prosperous week ahead.